Hello, everyone, and welcome to Your Finance TV. We're back here with Jay Pelosky for his Thursday musings. How are you, Jay?
Good, Scott. How are you? Yeah, it's Friday musings on Thursday. It's like getting tomorrow's news today. What's not to love?
And the title of these musings are Listen to Stocks, Not Vox. Now, listen, I know that you probably don't know this, but there's a website out there saying that called Vox says they've got the cleanest news, there's no bias or anything like that. But is this what it's relation to?
Somewhat. It really just struck me the other day, listening to various opinions, that, really stocks have been a much better kind of guide to where things are going than opinions, right? And Vox, I even put in my musings, the Webster's definition. Vox is defined as popular sentiment or opinion, the voice of the people. And so it just struck me that that's actually kind of a cool way to think about things. Because if you look at stocks, like last year, for example, most people thought we were heading into recession. Stocks had an excellent year. Stocks were the better tell. Today, look at credit, right? High yield credit is outperforming the ag, and yet people are worried about a slowdown, unlikely to happen. And perhaps the best example are commodities, where whether you look at gold breaking out, copper breaking out, COPX, which is a good size holding for us, copper miners, is actually the number one performing instrument we have in our global multi-asset model over the past month or so, up almost 20% in a month. Copper breaking out. And then energy looks like it wants to break out. XLE is at 94.50 today. 95 is a big level. And then the all-time high set a decade ago is $101 and change. And so commodities are clearly telling us that we're not slowing down, right? And gold breaking out is telling us that we don't really have to worry about inflation or higher rates. Rates can back or go up and go down a little bit, but gold is telling us that we don't have to worry about inflation taking off. We don't have to worry about rates backing up dramatically. And so all that together suggests that, we want to follow stocks, not opinions. And when we listen to stocks, credit, and commodities, the outlook is pretty good. And that dovetails with our fundamental outlook as well.
Okay, so you've given a couple like touched on things to touch on there, but can you give us some more examples of listening to the market? Listen, I've been around a long time in the market, and as of you, but for the viewers, give us some examples of listening to the market.
Well, it's when you listen to people say there's a big risk of recession, or actually the really good example today, again, which we reference in our musings, is the gap between investor sentiment, which is pretty constructive, right, pretty bullish for sure, and consumer sentiment, which is pretty negative and pessimistic. And actually, that gap is at a 30-year wide level. And that suggests, again, that somebody's wrong there, right? And we think, given what we just talked about where stocks are going, where credit is signaling, what commodities are signaling, that pessimistic consumer outlook is going to be the one that's going to turn out to be wrong. Another example from the equity perspective, which is really, I think, useful and digs a little deeper, is looking at cyclicals versus defensives, right? If you pick up the regular, Barron's or The Economist or most people writing about financial markets, it's all going to be about AI, right? It's going to be about NVIDIA. It's going to be about the Magnificent Seven, maybe a little bit about how Apple is actually not doing well, right? But you would think that that's the only game in town. The reality is that cyclicals are breaking out again all over the place. Home builders breaking out, transport's breaking out, industrial's breaking out. If you look at cyclicals versus defensives, cyclicals are stomping defensives. And so again, that's a signal. If we listen to that, it tells us that we don't have to worry about a slowdown. That in turn dovetails with the earnings outlook. and people can be as positive or negative on economic growth as they want. We've all been in the, well, we at TPW Advisory at least have been in the business long enough to know it's earnings, not economic growth, that matters. And so Q4, which we finished up a couple weeks ago, earnings growth was double what it had been expected to be at the start of the reporting season. When we look at 2024 as a whole, earnings forecasts are roughly double digit. If we look at 2025, also double digit expected earnings growth. When you have earnings growth that's solid, stocks are really not going to go down much. We can have a pullback, inevitable, normal, healthy pullback, but a big drop off, a big, portfolio sapping decline is pretty unlikely if those economic numbers, the earnings numbers pan out. When both of them are heading in the same direction, economy recovering, cyclicals outperforming defensives, stocks outperforming bonds, earnings expectations rising, all suggest that, the outlook is pretty robust.
Now, everyone knows you're a very busy person on media, Bloomberg TV, Schwab Network, and obviously your favorite, YourFinanceTV.
There you
This
go.
week you're with Winston Capital with a webinar. Can you tell the viewers what was happening in that webinar?
Yeah, no, it was actually, that was yesterday, and it was a busy day. We are, we are media folks, so we started out yesterday actually on the floor of the New York Stock Exchange, having a nice back and forth with folks on the Schwab network, and then we segued yesterday afternoon into a webinar with our buddies over at Winston Capital, and there we kind of walked through our kind of fundamental outlook, talking about earnings, which we just discussed, but also the fact that we're beginning a synchronized global rate cutting exercise. Over the last 2 weeks, as an illustration, the Swiss National Bank cut. It was the first of the G10, the big economies, first major central bank to cut. Mexico cut rates last week for the first time, joining other emerging markets, which have been leading the rate cutting cycle. And we expect 10 of the 11 or so major central banks to cut rates this year. That will be the most synchronized rate cutting environment since 2008. And we know what happened in 2009 and 10, really, really strong markets. In addition, we talked about the liquidity outlook, which is, again, pretty robust. And we referenced work that Apollo has done showing that the combined dollar amount of U.S. money market funds and bank reserves is now totaling $10 trillion, 10 trillion with a T. And that compares to, that's a double versus what it was before COVID, when it was about 5 trillion combined. So it just goes to kind of reinforce solid earnings, rate cutting backdrop, global liquidity, pretty robust. And then we think those things, those conditions set up the opportunity for the investor base and the central banks to kind of coalesce around a rate cut environment for 3 rate cuts this year, not 6, right? Remember in December, January, market was pricing 6 rate cuts, Fed was at 3. Same in Europe. And then, by the way, let's not forget the Bank of Japan, which last week ended its negative interest rate policy and yield curve control policy that had been in place for, I think, something like 17 or 18 years. And that, too, was met with barely a ripple of financial market unease. So we've done some significant work bringing financial central banks and financial markets in sync. And that's really constructive for our view, right? Remember our 4 for 24 macro surprises. Number 3 was return to stability. Number 4 was we're in an early cycle global economic recovery. Well, we have, just by putting together the markets and the central banks dovetailing their rate views, that really reduces the risk of a big, blow up, because markets and central banks are in, reading two different tea leaves. We're all reading the same tea leaves, and that's really constructive, again, for the outlook, which we think, where we differ now, we wrote a piece, remember, 2 weeks ago called Catch Up is Okay. Catch up is in people catching up, not catch up is in give me a burger with ketchup, please. So, people have caught up to our view for the most part tactically, but where people have not yet caught up, and we think this is the real key going forward, is our view that we're in the early stages of a multi-year kind of blue sky, positive economic and risk asset environment that will be driven in large part by the regional integration we talk about in our tripolar world framework, where we have supply chains regionalizing, every country focused on AI and semiconductors, every country focused on climate and climate proofing their economies. All these things mean a lot of spending. A lot of spending means good earnings. And by the way, you could say, well, doesn't that also mean inflation, Jay? And remember macro surprise number 2, which is better than expected productivity. And on that note, last week, McKinsey, one of the world's best consultancies, came out with a report very positive on global productivity growth. And so that's going to be one of the real keys to watch, right? Are we able to grow faster without inflation? Productivity is going to be the key. And it's not just AI. It's really the fact that labor markets are tight and capital is relatively available. Remember the 10 trillion in money market funds and bank reserves. And so companies are going to be focused on capital investments to drive productivity, because the workforce, they just can't, find workers or get workers, given that not just the US, Europe, record low unemployment, Japan, low unemployment, many parts of the EM, low unemployment, and therefore driving productivity, enhancing growth without inflation. And that is our thesis for not just 24, but 25, 26, 27. And that's where we still are ahead of most people who have not yet gotten beyond the fact that tactically things are constructive. We're constructive tactically, but more importantly, strategically over the next several years.
So Jay, we're recording this on Thursday after the close. We've finished the quarter. The S&P's had its best start to a year, or first quarter in a year since 2019. I'm sure you'll write more about this in your monthly next week. But what should clients really be looking at, or what should they be doing today?
Yeah, no, that's a great question, Scott, because as we just talked about, it's been a pretty good quarter, and that's on the back of a pretty decent year. But let's level set, okay? Let's level set. And one way to level set is to note that ACWI, so this is global equities, right? All country world index, ACWI is up 5% over the last 2 years. Because we have to go back and remember that 22 was miserable, right? 23 was pretty good. The start to 24 has actually been quite good, as we just discussed. But over the last several years, 5%. ACWI is up literally 5%. There are big chunks of the emerging markets which are down over that period. Think about China, right? There are parts of the developed world that are up, but not up in a huge fashion. And parts of the US that likewise are not up in a huge fashion. And here we're thinking about things like small caps. So when we think about the markets today, we want to stay invested because we are constructive. We look at that earnings outlook, synchronized rate cutting cycle, abundant global liquidity. We want to stay invested. We want to be ready for the inevitable pullbacks, right? A 3 to 5% pullback happens on average 5 to 7 times a year. That's just data. That's just facts. Okay, so we should be ready for that. We haven't had one in a while. But what do we do with that? We would add 2 positions. We want to be both in the leaders, like tech, particularly in the semi space. We're believers in the AI innovation age, and cyclicals in the US. We talked about that earlier. Cyclicals are breaking out. And we want to be in the laggards. And in the laggards, in the US in particular, that to us is small caps. And if you look over the last couple of days, people they want to have in their portfolios for quarter end small caps have had a pretty good couple of days. And I think that's people positioning. And we think one of the big catalysts there could well be the Fed cutting rates, which we expect in June, along with most other people. And June is not that far away. We're in April when we come back on Monday. So internationally, outside the US, we continue to be in the leaders, which is EFA, Europe and Japan, and we want to be in the laggards, which is emerging markets. We continue to be constructive on Latin America, Mexico, and Brazil. Really haven't done much at all this year. They're essentially flat. So lagging, actually, right, relative to the rest of the markets. ACWI up 9 or 10%. And then we want to be in China, which we've talked about quite a bit. And what's interesting right now, and we are going to be talking and writing about this more in particular, is it's becoming very clear that there are going to be two tech stacks, one US-centric and one China-centric, right? We're blocking China from accessing the most cutting-edge technology, and China is starting to block US companies from selling into their marketplace, right? We heard that this week where the government agencies in China are no longer going to be able to use computers that have US chips in them. So China is playing a little bit of tit for tat. So what's interesting is, what is the China tech stack that is going to dominate a marketplace with 1.4 billion people growing at 6% per annum? JP Morgan just raised their Q1 forecast, 6.6% GDP growth annualized for China. What is that tech stack worth versus the US tech stack, 300 million people growing at 2 to 3% per annum? You know, it's a very simplistic way of thinking about it, but right now China sells at about a 70%, China tech, about a 70% discount or more to US tech, right? Alibaba trades at 8 times earnings. Tencent trades at 14 times earnings. And by the way, these companies are buying back stock, paying dividends. They're the same cash-making machines that US big cap tech is. So we made the point before, we'll make it again. KWeb, which is China tech, can double from where it is today and double again and still not get to its 2021 high. The last segment, last area where we're really quite constructive and we would be putting money to work today is in the commodity space, right? Commodities, we think, are kind of the very unsung leaders year to date. I think very few people, if you ask them, even financial professionals, what's the leading asset class year to date? Stocks, bonds, currencies, commodities. Well, number 4, commodities, is the world's best performing asset class in the first quarter. Very few people have that in their kind of their bingo card or scorecard. And so we want, and as we mentioned earlier, gold, copper, oil, all breaking out, right? It's not just one piece of the commodity side, it's the whole thing. And supply concerns, supply constraints, better sense of the global economy picking up as we go through 2024, 6% growth in China. There's a really interesting dynamic going on, and we see it. We see it in our global multi-asset model portfolio, where over the last month, the 2 best performing positions are copper, COPX, and energy, XLE. COPX is up 19% over the past month. So, you know, there's some stuff going on in the commodity space. And again, we think it's for real. And we want to be exposed there for that multi-year period of better than expected global growth, that early cycle thesis that we have at TBW Advisory that others have still not yet cottoned on to. And when they do, they're going to realize they're very underweight commodities. We here at TBW Advisory in our global multi-asset model have a double weighting in commodities versus our benchmark. And we have had that for the last 6+ months.
All right, Jay, listen, before we this probably won't get published till about Sunday, but have a great Easter. But one last little stat for like, because you love stats and like little statistics. Obviously, we have the basketball this weekend. Duke, everyone knows the history with you with Duke. Have you got any little statistic for us on Duke this week?
Yeah, I do actually. Duke is the only school in the country, Scott, that has both men's and women's basketball teams still dancing in the Sweet 16 and that won its football bowl game. And so, I'm a football guy, so I got to get that football aspect in there. But that's pretty good for a small, private North Carolina university. Men's and women's basketball, both in the Sweet 16, and the football team winning their bowl game. The only school in the country that can make that claim. Go
I feel
Duke.
like it's an ESPN statistic. So, anyway, have a great weekend, Jay, and we'll be talking to you again soon.
Happy Easter.
And for everyone else out there, good luck investing.